Hi friends, when it comes to building a stock portfolio, you must follow few practices. If you do not follow these practices, then you are likely to make a lot of mistakes and in fact, you might lose a lot of money. Now, I'm not a stock portfolio advisor, but I have myself made a lot of mistakes while I was building my own stock portfolio. And through these mistakes, I have learned a lot. I really do not want you to make those mistakes. So I'm creating this video where I will teach you how to go about build a great stock portfolio in a simple step-by-step manner. If you're new to my channel, please do not yet subscribe to my channel. Watch this content for few minutes and I'm pretty sure you are going to become a lifelong subscriber. With that, shall we get this video cracking? Let's go. So according to me, there are total 5 steps in building a great stock portfolio. Most people start from step number 5. They do not have step number 1, 2, 3, 4 in place when they're building their stock portfolio, and therefore they make a lot of mistakes. So let's start with step number 1. What is the step number 1? Step number 1 is to write down the goal of your stock portfolio. A lot of people do not do this. So what is the goal of a stock portfolio and why it is important? Allow me 2 to 3 minutes of time and I'll explain with some examples. So first of all, what is the goal of your stock portfolio? It could be something like, I want to build a stock portfolio that will give me between 20 to 20% CAGR returns after 7 years, and I'm okay to see a maximum drawdown of up to 20% at any given point in time. This is just an example here. I've spoken about 3 crucial numbers here. Number 1 is 20 to 20% CAGR returns. It could be any number. It could be 15%, it could be 22%, it could be 40%. Whatever you wish to aspire to generate from your stock portfolio, you must write it down. It has to be a range, and more importantly, this will help you assess your own performance. You are not going to assess your own stock portfolio's performance versus somebody else. That is a futile exercise in my view. This will help you measure your own performance, and that will allow you to change your strategies if you are not hitting your goal after the time frame. That brings me to point number 2, which is the time frame, which is here in this example I have used after 7 years. So please understand, whenever you're speaking about stock portfolio returns, you're looking at a time horizon cumulatively. For example, if 1 year your stock portfolio is doing 20% returns, another year it is doing 2% returns, you are not going to look at these 2 years. Of course, you will look at these 2 years from a learnings perspective, but you are going to look at your stock portfolio returns cumulatively. Within, let's say, 7 years, if it has generated 20 to 20% CAGR returns, it has met your goal. So time frame is extremely important. Please make sure you do not have a time frame which is lower than 3 years. For stocks to generate profits, returns, the magic, you have to have minimum period, and in my view, that is minimum 3 years. Set yourself a target of minimum 3 years. And the third crucial number here, it is the drawdown of up to 20%. A lot of people start with, I want to build a portfolio that will give me 100% returns, but they do not set a downside risk for their portfolio. Extremely important point that a lot of people don't define. So I would highly request you to make sure you are writing down what is your drawdown limit, what is your risk appetite. If your portfolio falls by 20%, are you okay with that volatility or not? Because once you define these 3 parameters, 1 is the returns expectation, number 2 is the time frame, and number 3 is the drawdown, which is the risk appetite, it will help you set your target strategies. And I will talk about that in step 2, step 3, step 4. But at a high level, this goal will allow you to select the right sectors, select the right market caps, select the right themes, whether they're short-term, long-term. A lot will hinge on your mission statement or the goal statement of your stock portfolio. If you have not yet defined, write it down today. Write it down now. Pause this video. Go and get a pen and paper. Write it down. Whatever it could be. Let me know in the comments and I may be able to review some of these goals and might be able to comment on these goals. Just like how we want growth in our portfolios, if you also want to grow your business, try ODU, partners of this video. ODU is a business software that comes with more than 45 plus applications such as finance, sales, inventories, and much more. But rather than hearing it from me, you can discover ODU yourself. by attending a massive networking opportunity for business owners via ODU Community Day 2025. This is a 2-day event happening on August 13th and 14th, 2025 at Mahatma Mandir, Gandhinagar, Gujarat. It's completely free event, but the reason I'm speaking about this event is because you will have an opportunity to attend 200 plus talks and demos by experts, attend influencer talks and guest sessions, learn from real businesses and entrepreneurs, network with 20,000 plus business professionals, entrepreneurs and influencers. Discover the latest version of ODU 19. And last but not the least, you can network, eat and enjoy the concerts and after party. The link to the ODU Community 2025 is in the description. Share this in your network so that your loved ones can take this opportunity and get massive benefits out of this event. Once you've written down your goal of the stock portfolio, comes the step number 2, which is to define the stock universe. Stock universe, when I say, I mean the sectors that you're going to pick the stocks from, and secondly, the market caps that you're going to target. Extremely important point here. And if you do not do this point, what is going to happen is that your portfolio is going to look like a sabji mandi. It will have potatoes inside it. It will have cauliflower inside it. It will have spinach inside it. And you do not know what is good for you and what is not. I've seen people who have Tata Motors in their portfolio. They also have a penny stock in their portfolio. Now there is no focus strategy here. Therefore, what we need to do is select our stock universe. So there could be different types of goals, right, that you might have written down in step 1. I'm going to divide the stock portfolios into 4 broad categories. Okay. So on the y-axis, there is time frame here, and let us divide the time frame into 2 parts. Short term, which is let's say 3 to 5 years, and long term, which is more than 5 years. So if your stock portfolio is let's say 10 years, 12 years, sort of a time horizon, then you fall under the long term horizon. And on the x-axis, we are going to divide into 2 broad categories. This will be based on the risk appetite. Number 1 is the low risk. Let's say if your maximum drawdown capacity is up to 20%, then you are a low risk investor. And second is the high risk investors, people who are willing to go and take that volatility risk of going down by almost up to 40%, then it becomes a high risk type of a stock portfolio. So we've got total 4 main categories here. 3 to 5 years, 5 to 20 years, for example, low and high risk appetite. Now, depending on which type of stock portfolio goal you have written down, you will fall into one of these. You might have multiple portfolios, but essentially you will fall into one of these for one stock portfolio. Now, how to go about setting up these stock portfolio universe? Let me walk you through. Now, let us assume that you are building a short-term portfolio for 3 to 5 years only. The first thing you need to do, whether you are a low risk or high risk, is to avoid cyclic sectors. Extremely important point. Cyclic sectors, for example, metal sector is highly cyclic. There is going to be upward movement of the sector, then it will be followed by a downwards movement depending on various factors, which we are not going into details of that. But you need to avoid cyclic sectors. Why? Because your time horizon is very short, 3 to 5 years. Just imagine you end up picking a stock from metal industry, and the moment you pick the stock, after few weeks or months, the sector itself start to come downwards. What is likely to happen in your stock? Your stock might also get impacted because the sector is facing a lot of headwinds. And since your time horizon is short, there is very little time for recovery. And there is likely to be either a loss of money for you, or there might be a sideways movement. You might witness something called as time correction. So please make sure you are avoiding cyclic sector. The very good strategies for short-term portfolios like 3 to 5 years is to stick with evergreen sectors. Evergreen sectors, for example, FMCG sector, for example, healthcare, pharma sectors. These are sectors which also have some cyclicity. It's not that these sectors are free from cyclicity. There will always be, for example, inflation rate is high, then FMCG sector might see some pressure. But the cyclicity is not huge and it quickly recovers itself. It's not a long duration cyclicity, right? So stick with these sectors. You are likely to do well. Your portfolio is likely to do well because you're building it for short term. Second point comes is the stock universe in terms of the market cap selection. So if you're building a short term portfolio and if your risk appetite is low, then please make sure you're sticking to Nifty 100 as a universe. Please do not go and pick up a mid-cap stock or a small-cap stocks, because please remember, you are talking about low risk here. You do not want to see drawdowns of, let's say, 30%, 40%, 50%, 60%. I know a lot of small-cap stocks that are down by 60%, 70% since we have just come off the correction. Please make sure you are finding your universe to be Nifty 100. That is going to be large cap and you're likely to find very good quality large cap stocks. The drawdown in these large cap stocks typically is lesser than mid cap and small cap. The second is, if you are happy to have high risk appetite, drawdown of up to 40%, then in that case, Nifty 300 in my view makes a lot of sense. You are going to cover large cap stocks there, mid cap stocks there, as well as few quality top 50 small cap stocks. This is a very, very good universe. Now, do not venture into a micro cap stock here because your time horizon is very, very short. Therefore, please make sure Nifty 300 becomes your universe selection. When you apply these strategies to your stock portfolio, you're going very, very focused. You're going as per your goal. That's why I said in step 1, you have to first write down your goal. Now comes the long term, which is, let's say, 5 to 20 years of horizon. If you're building a long term portfolio, then you don't need to worry about cyclicity. You can definitely go with any sector that you like. But here, what I would say is stick with allocation here. So evergreen themes, 40% allocation for your portfolio. Long-term themes should have more allocation here, 60%, because you're building a portfolio for long-term. You're picking stocks that need some time to grow. And what are the long-term themes? I recently created this video. Go and watch this video. Here I've spoken about 4 to 5 sectors, which for the next 5 to 7 years are likely to show very, very good growth rate. These are long-term sectors. If you pick stocks from long-term sectors, then your portfolio is going to benefit because of the compounding impact, right? When it comes to the market cap, since you do not have a lot of risk appetite, your risk appetite is low, please make sure you stick to Nifty 300 universe for selection. Here you can go slightly higher, which is Nifty 300. Why? Because your time horizon is much better, much longer, 5 to 20 years here. And when it comes to high risk stock portfolios where the drawdown could be up to 40%, in that case, you can definitely go up to Nifty 500. You can select even small cap stocks because you are happy to see the volatility. You are not going to get panic. Therefore, please make sure you are going ahead and selecting these stock universes based on your goal portfolio. So far, if you're liking this video, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to bring such content for you at zero cost. Also, if you practically want to learn investing and want to become a better investor, you can consider joining my paid YouTube community. Feedback of this community has been excellent because I post almost on a daily basis, bringing you latest insights from markets, ETFs, mutual funds, various assets I cover on this particular community. Simply go to my channel, press the join button and be my guest. With that, let's move to step number 3, which is understanding what types of stocks we are going to pick here. You might be wondering that, Rahul, we wrote down our mission or the goal of the stock portfolio in step number 1. There we talked about the returns expectations. In step 2, you talked about the risk appetite and the time frame, but you never spoke about the returns expectations. How to go about meeting the returns expectation. So this is where the step 3 comes into picture, where we are going to discuss which types of stocks are we going to pick up based on your returns expectations and which types of stocks are we going to avoid. So here there are 2 categories. Let's say you are into a category where you are trying to build a stock portfolio that is likely to generate returns, or your returns expectations are, let's say, up to 20% CAGR basis. The second type of portfolio is where you are looking for high returns expectations, where the returns expectations are beyond 20% CAGR basis. It could be 25%, 28%, I do not know. Right? Sky is the limit here. So here, first thing which is common in both the portfolios is we need to understand. First of all, we're only going to pick stocks that are quality stocks. And second point is the stocks that have reasonable valuations. If you get these 2 things right, which of course comes with a lot of experience and a lot of time that you put into a stock market, but we have to make sure we are picking the quality stocks. By quality, I simply mean 3 to 4 things we need to look for. Number 1 is very good financial track record of the company that we have to look for. Secondly, we have to look for the management or the promoters of the company, reputed management, reputed promoters. And thirdly, the most important thing is the future prospects, future growth prospect of a company. If they are bright, that's when we pick the stock, right? And the second is, of course, the reasonable valuations. I speak about valuations in terms of PE ratio, PB ratio, PEG ratio, right? There are a lot of ratios that we could use. But please make sure you're only picking stocks that are quality stocks and with reasonable valuations. Both are important. Also, avoid stocks that have corporate governance issues. Secondly, companies that are continuously making losses, which have no plans to become profitable. I can give you a lot of examples. I don't want to throw names here, but I hope you get my point that you are sticking to companies that are profitable. And if you are investing in a company that is making losses, you know when the company is likely to turn EBITDA positive, for example. Third is Avoid those companies where there are no regular earnings call, right? Because if management is not delivering any earning calls, you're not likely to get insights into business operations. Fourthly, avoid penny stocks. Humble request you to avoid penny stocks because no matter how much risk appetite you carry, penny stocks are a dangerous game. I have learned that over a period of time. So I am sharing this very, very honestly with you. And number 5 is exclude those companies where there is no DIs or FIs stake. It means the company has not been vetted by an institutional investor. Even if you do these basic things, right, whether you generate up to 20% CAGR or more than that, this itself will allow you to not incur a lot of losses in my view, right? Now comes the $1 million question. How do we generate lesser returns versus higher returns, right? Now, if you are happy with lesser returns, let's say up to 20% CAGR, again, these are not guaranteed returns. Please understand this. These are expected returns and we are working towards getting the expected returns. So let's say up to 20% CAGR, you don't need to take unnecessary risk. You can stick to simpler businesses where there is no business moat. You don't need to look for business moat. For example, let's say HDFC versus SBI Bank. For example, banking stocks. HDFC stock, SBI stock. Tell me there is no strong business moat here between these two banking stocks, right? There are of course differentiators between these two stocks in terms of their number of branches, their operations, their management, many things, but there is no clear business moat. So you're happy to pick simpler stocks. Don't need to go any fancy because your returns expectations are up to 20% CAGR. Easily you can find stocks which are quality stocks and you hold these stocks for a long period of time. You are likely to build wealth over a period of time. Then comes high returns expectations, which is beyond 20% CAGR. Here, in my view, if you want to generate high returns, the only way to generate high returns is picking those stocks that have a very, very clear and strong business moat. That is what the point is. Every stock you pick must carry a very, very strong business moat. Can I give an example? For example, a pharma company that is manufacturing APIs, which only 1 or 2 companies in the world are making. I picked up a stock long time back into pharma sector. That's why I'm able to give you that example. And I made good money out of that stock. Why? Because there was a clear business moat of that particular stock, right? So this is the main key difference between how to build a stock portfolio which is going to give you lesser returns versus higher returns. Because it's extremely hard to pick businesses that have business moats. Only very few people are able to generate more than 20% CAGR returns. Even 20% is a stretch in my view. But in my view, I've shared with you how to go about picking stocks in terms of low returns or high returns. With this, let's now move to step number 4, which is to define the rules of your portfolio. There are 3 rules that we must define in our portfolio. Rule number 1 is the sector allocation rule. So how much maximum allocation you will do to one particular sector is the rule you have to decide. For example, banking sector, power sector, FMCG sector, what type of stocks you will pick so that the cumulative allocation to one particular sector is not going beyond the limit. Industry practice is around 20%. You shouldn't be really allocating more than 20% of the allocation to one particular sector. Can I give an example? Let's take an example of Parag Parikh, right? A very, very solid stock portfolio mutual fund house. For that, let me show you very quickly the data. This is the latest portfolio of Parag Parikh. You can see the stocks here, you can see the sectors here, and you can see the total allocation by the particular stock. If you roll up these sectors here, for example, banking sector, I have done the pivot here, and what you note here is that maximum allocation right now they have is to banking sector, which is around 20%. And if you look at other sectors than bank, you will note that all other sectors are in single digit. For example, fuel 6%, FMCG 4%, finance 7%, power only 6%, so on and so forth. Point is, for you, you must define what is the maximum allocation you will do to a sector. 20% seems to be a very, very good thumb rule. Second rule comes is, what is the maximum allocation you will do to one particular stock? Okay. Here again, if you look at this particular portfolio, let me come back here and you will note that they haven't really allocated more than 6 to 7% to one single stock. If you see this particular allocation here, 6% they have allocated to Power Grid Corporation of India Limited. Not a recommendation here. These are examples we are looking here, right? So here you will note not more than 6%, 7%. In my view, my allocation rule is 10%, not more than 10%. However bullish I am about a particular stock, however stronger conviction I have, more than 10% is too risky for a portfolio, because all of a sudden, if there is a problem in the company, then you are exposing huge risk to your portfolio. right? That is the second thumb rule you have to decide for yourself. Third one is not a thumb rule, but a very, very good practice that we all must follow is about how to buy a stock gradually and how to exit a stock gradually. You never buy a stock in one go. You gradually build positions. Again, let me show you examples from Parag Parikh's portfolio. This is the portfolio that I analyzed for 4 months between October to January. And very quickly, you will see patterns here. For example, this particular stock here, MCX, what you will note here is that from October, they started to sell off. So the position started to come down gradually. November was stable, but in the month of December, they sold some part of it. In the month of Jan, again, they sold some part of it. So they were gradually coming out of this particular stock. Very, very similar pattern here for CDSL as well. They started to gradually exit the particular stock. They were never exiting the stock in one go. Likewise, when you're building the positions, let me give you an example of Cipla Limited, how they gradually build the position. So from 41 lakhs to, let's say, 41 lakhs in the next month, 52 lakhs. 62 lakhs and so on and so forth. So they've gradually built the position in particular stock. This is one thumb rule that you also should try and follow, because what will happen is that your cost of buying or cost of exiting a stock will be averaged out. So this is all about step number 4, where you're following these 3 rules, extremely important rules that we must follow. Now comes the step number 5, which is the final step, which is actually picking the stocks. A lot of people start from step number 5. They ignore step number 1, 2, 3, 4. But hopefully in this video, you got a good view of 1, 2, 3, 4. And now comes step number 5, which is going and picking the stocks. Now there are hundreds of strategies to pick stocks. For example, I talked about dividend stocks in this video. I feel depending on the market conditions, you have to deploy the strategies. Right now, for example, picking the dividend stocks is a very, very good strategy. Why? Simply a lot of dividend paying stocks, quality dividend paying stocks are down. And when you pick a stocks, which is a dividend paying stocks at a lower price, your dividend yield goes up. Again, I've covered all of that in this particular video. You can go and watch this video. Second strategy example could be beaten down stocks. Since we have just come off the correction, there are still quality stocks that are sitting at 40% drawdown, 50% drawdown. Good strategy right now is to find value in those particular stocks, pick it up and hold it for next 3 to 5 years. Wait for the next bull run to come. You're likely to make money. You're likely to make good returns if you go about this strategy. Again, as I said, there are hundreds of strategies and I cannot really talk about those strategies, but I speak about those strategies on my YouTube channel, on my paid YouTube community. Go and join the community if you're not yet a subscriber to that community. Subscribe to this channel. There is a lot of free content out there anyways. Also watch others' videos as well. Read some books, learn yourself, do some research, and you are ready to build your own stock portfolio that are not likely to give you losses, hopefully, if you follow these good practices. And hopefully, if you hold the portfolio for a longer period of time, you're likely to build a wealth. I hope you enjoyed this video. If you did, press the like button. Let me know in the comments a simple thank you. I look forward to see you in my next video. Until then, keep rocking.